This is the week gold and silver stop moving like news and start moving like a stressed market that is running out of easy liquidity. You can feel it in the way the tape behaves. The headlines scream one thing, the price flickers another, and the real signal hides in the plumbing where almost nobody looks. And if you stay with me to the end, you'll have a simple checklist for the next 7 to 14 days, the levels that actually change behavior, and the one invisible pressure point that can turn normal pullback into a sudden vertical move. Because the fight right now isn't bulls versus bears, it's flow versus capacity. It's the market trying to digest a massive 2025 run without breaking its own structure, while the calendar forces participants to make decisions they've been able to postpone. And that's where the real pressure starts. Let's put the price action in context first, because you need the backdrop to understand why this week matters. Gold is sitting around the mid $4 400s per ounce, and that alone should tell you how different this regime is. Banks are openly talking about $5,000 as a plausible print in the first half of 2026, while also warning about violent corrections in a wide trading range. In other words, even the institutions aren't pretending this is a calm market anymore. Meanwhile, silver has been the wilder sibling, ripping up toward the low 80s per ounce earlier this month and then snapping back hard. The kind of daily move that punishes anyone who confuses volatility with trend reversal. In local markets, you can see the same whiplash in physical terms. The kind of day where the retail price can drop sharply in a single session after record highs. Not because silver suddenly became less useful, but because profit-taking hits all at once when positioning is crowded. That's not a story about sentiment. That's a story about structure. But that's not the part that matters. The part that matters is what's happening underneath the headline price, because spot can drift and still be misleading. The hidden detail, the one most people miss, is that the price you see is a compromise between paper liquidity and physical reality, and the compromises get harder when the curve and the spread start tightening. At the same time, the calendar squeezes the market S-schedule. Think of the metals market like a multi-lane bridge. Spot is the big sign over the bridge. Futures are the lanes. Options are the traffic rules that suddenly change at specific times. And physical deliverability is the weight limit nobody talks about until a truck shows up. Right now, the weight limit is what you should be watching. Because if the market senses that the truly deliverable pool is tightening while demand stays sticky, it doesn't negotiate with polite little candles. It rations with price. And when it has to ration quickly, you don't get a smooth staircase. You get gaps. You get air pockets. You get forced behavior. But here's where the conflict comes in, and it's why CTR is so high on a title like this. A big chunk of the mainstream crowd will look at a pullback after a big run and call it the top. They'll say the move is exhausted, the froth is gone, the story is over. And a big chunk of the metals crowd will do the opposite and slip into certainty, turning every dip into proof of a villain and every rally into destiny. Both camps lose money the same way. They watch the wrong indicators and they react emotionally to noise. The edge this week is not in being louder, it's in being more precise. Because the market is approaching a calendar window where precision matters. And if this one level breaks, the math changes. Here's the why now trigger in plain terms. We are early January, and that's when fresh year positioning meets delivery timing, roll schedules, and option calendars. Funds rebalance, hedgers adjust, dealers clean up books, and liquidity can be thinner than people expect because participation doesn't return evenly after the holidays. It returns in bursts. The market is like a room where half the chairs are still stacked against the wall, but the music starts anyway. That's why early January can produce outsized moves on ordinary catalysts. Now add one more ingredient. The options and futures machinery has actual dates when pressure concentrates. For gold options tied to the next major contract month, there's a late January expiration window that forces the dealer community to change hedges, and those hedges are not opinions. They're mechanical. They happen because risk managers demand them, and mechanical flows don't care about your narrative. That is the calendar catalyst. It's not mystical, it's scheduling, and the next detail is what flips the whole setup. When you stack calendar pressure on top of a market that just had a historic year, gold up massively in 2025, silver behaving like a coiled spring, the room for positioning errors shrinks. People can't hide in, I'll fix it later. Later is now, but don't take my word for it. Look at the symptoms. Silver just gave you a textbook example. A surge to extreme prints, followed by a fast reversal. That doesn't mean the bull case is dead. It means the positioning got crowded and the exits got narrow. In a crowded trade, the first wave out can be violent because liquidity providers widen the spread to protect themselves. That widening is the market saying, if you want out right now, you're paying for immediacy. And that's exactly why the spread matters more than the spot. Because spreads are where the market confesses its stress. But that's not the part that matters either. The part that matters is what stress forces participants to do next. So let's talk mechanism, simply because the metals market can look complicated until you reduce it to incentives. Futures set the reference price that most headlines quote, but futures are, at their core, standardized claims. Physical metal is the final settlement reality, and the bridge between the two is deliverability, what can actually show up in the right form, in the right place, on the right schedule. Not all inventory is equal. Some metal exists, but isn't in deliverable form. Some is in the wrong location, some is spoken for. Some can't move quickly because logistics are slow and refining capacity is not a light switch. That's why inventory headlines can mislead. The market cares about the tight slice, the deliverable slice, the slice that can satisfy obligations without begging for time. And when that slice tightens, the market starts paying up at the front end. That's what term structure is, the curve of prices across time. And term structure is the market's way of telling you whether it feels comfortable or strained. In a comfortable market, later delivery is often priced higher because carrying costs exist. Storage, financing, insurance. That's contango. In a strained market, the front month can trade richer relative to later months because the immediate need outweighs carrying costs. That's backwardation, or at least a backwardation pressure. You don't need to worship the jargon. You just need to understand what it implies. When the front is bid, someone wants metal now. And now is always more dangerous than later. Because now is when people get squeezed. But here's the real twist. Even if you can't see every inventory detail, spreads will still tell you when the system is under tension. When bid-ask spreads widen in key venues, when nearby spreads act tight, when the market pays more for immediacy, it's not just a trader's mood. It's the market's risk budget shrinking. Market makers and dealers provide liquidity by warehousing risk. In a calm market, they can hold that risk and hedge it smoothly. In a stressed market, they hedge faster, they hedge more aggressively, and they demand higher compensation. That changes how price moves. It turns price from debate into flow. And when price becomes flow-driven, it can move farther than anyone thinks is rational. Because the goal is not to be rational. The goal is to get neutral. This is where options reflexivity enters. And at S, one of the cleanest explanations for why a move can start this week without a dramatic headline. Dealers who sell options often hedge their exposure in the underlying futures. The hedge ratio changes as price changes. That's delta. And the rate of change of that hedge ratio is gamma. When a market is near big option strikes, levels where lots of open interest sits, small moves can trigger large hedging flows. If price rises toward a major strike cluster and dealers are short gamma, they may have to buy as price rises to stay hedged, which pushes price up more, which forces more buying. That's reflexivity. It's not a conspiracy. It's the math of hedging interacting with concentrated positioning. On the downside, the same dynamic can accelerate sell-offs. And that's why this market can whip around violently, even if the bigger thesis is correct. Trend signal and noise can coexist, the trend can be up, and the path can still be brutal. That's the game. And that's where retail investors get emotionally harvested. Because the market doesn't just move, it tells stories while it moves. It uses speed to convince you something changed, when often the only thing that changed is the urgency of hedging. Keep that in mind, because in a few minutes, we are going to build your psychology shield for the exact tricks this volatility uses. But first, let's stack proof, because trust in markets comes from mechanisms plus multiple independent signals. One signal is a rumor, 5 signals is a map. Proof point 1 is the macro backdrop that keeps safe haven demand alive even when rates don't cooperate. Gold doesn't need rates to fall, it needs uncertainty about rates and uncertainty about the currency regime. When central banks and institutions face geopolitics, trade friction, and debt dynamics, gold becomes a reserve behavior, not just a trade. You can see the institutional sensitivity in real examples. Big official sector holders and central bank-linked balance sheets can swing dramatically in profit when gold rises. That doesn't tell you tomorrow's price, but it tells you the scale of gold's footprint in the system. And in a year where gold's move was historically large, it's not a fringe asset. It's a system asset again. That's proof point 1. The macro regime is not normal. Proof point 2 is the calendar pressure we already touched. Earlier positioning plus late January option timing creates a window where hedging flows can be amplified. This is the kind of calendar setup that doesn't guarantee direction, but it guarantees intensity. Proof point 3 is the street level symptom in silver. Sharp reversals after extreme prints, including abrupt drops in physical pricing in major retail markets after record highs, are consistent with profit-taking waves that happen when positioning gets crowded. Crowded positioning doesn't disprove the bull thesis. It tells you the bull thesis is popular enough to be dangerous, and popular enough to create squeezes when the crowd is on the wrong side at the wrong time. Proof point 4 is supply chain reality, especially for silver. Silver is not mined like gold in a neat, controllable way. A large portion of silver supply is byproduct from base metals. That means silver supply does not respond quickly to a silver price spike. If copper or zinc production slows, silver supply can slow even if silver demand rises. Refining capacity, assay, and logistics add friction. Recycling helps, but it's not instant and it's not infinite. That's why silver can behave like it has a lagged fuse. Demand can surge faster than supply can adapt. Proof point 5 is cross-market behavior. The relationship between gold and silver and the way the ratio compresses and expands often signals whether silver is in catch-up mode or exhaustion mode. When silver outperforms, it tends to do it violently. When it underperforms, it can drift and then snap. We've just seen the violent version. The next detail is what flips the whole setup again. Violent outperformance, followed by sharp pullbacks, often sets up the second wave, the one that catches skeptics leaning the wrong way. That's not a guarantee, but it's a pattern that lines up with structure-driven flow and constrained supply. Now, let's address the elephant that always shows up in metals. Conversations, suppression, manipulation, the idea that someone is always leaning on price. Here's the finance-literate way to talk about it without turning your brain off. You don't need a secret room to explain why price sometimes behaves like it's being sat on. You only need incentives. Dealers and banks prefer orderly markets because disorder creates hedging losses, margin shocks, and risk committee nightmares. Funds prefer liquid exits. Producers and consumers prefer predictable hedging costs. When a trade gets crowded and volatility rises, the natural response of the system is to dampen chaos, widen spreads, reduce risk limits, and manage exposure more aggressively. That can look like suppression to an outsider, but it's often just risk management interacting with thin liquidity. And when risk limits tighten, the market can lurch. That's why you should frame this as a structure story, not a morality play. The market is not out to get you personally, it is out to neutralize risk. And if your emotions become a source of predictable behavior, the market will absolutely take advantage of that predictability. Because if this one level breaks, the math changes. So let's talk levels, not as magic lines, but as places where participants are forced to act. In gold, the mid 4,400s zone matters because it's where the market is currently negotiating between hold the breakout structure and release some steam. The clean push and hold above roughly $4,450 to $4,280 starts to shift the conversation from pullback to continuation because it pressures those who sold strength to hedge back up. A decisive move through $4,500 is psychologically loud and mechanically relevant because round numbers attract options positioning and stop placement. Above that, the market starts staring at higher targets quickly because there's less recent structure to lean against. On the downside, the $4,400 area is the first line where bulls want to see demand show up. Below that, the next key zone is around the low to mid 4,300s. Think 4,330 to 4,350, because that region lines up with recent price history and is the kind of level where trend-following funds watch for retest and hold. If gold loses that zone and the market can't reclaim it quickly, the thesis weakens. Not because the long-term story dies, but because near-term pressure is releasing and the calendar squeeze may be diffusing. That's your invalidation framework. Not, I feel bearish, but the structure relaxed, the curve stopped tightening, and price can't reclaim the level that should have acted like a floor. Now silver, because silver is where the fireworks usually come from. Silver pushing into the low 80s and then snapping back toward the high 70s tells you exactly where the battlefield sits. The $80 handle is a magnet. It's psychological. It's mechanical. It's where a lot of people place stops, take profit, and set option strikes. If silver reclaims $80 and holds it with momentum, the market is telling you the pullback was a liquidity shake, not a regime change. If silver instead chops below $80 and grinds, you watch the 76 to 77 area as the first meaningful support zone because that ain't room S where the recent pullback found air. If that zone fails, you were looking at the low 70s as the next stabilizer, around $72 to 73, because that équilibre where earlier January prices lived before the acceleration. A break of the low 70s coupled with relaxing spreads and a calming curve would suggest the squeeze pressure is off, at least temporarily. But if silver holds those supports while gold stays firm, the odds of a second push increase because silver's supply chain doesn't suddenly become flexible. And that's where the real pressure starts, because the second push is often the one that turns skeptics into forced buyers. But you have to respect volatility. Silver can whip around violently even if the bull thesis is correct. It can drop 5%, then rally 8%, then drop again, all inside a window where the underlying pressure is actually building. That's why you need the two-scenario lens, because it keeps you from narrating yourself into a corner. Scenario 1 is the controlled pullback and retest. In this scenario, Gold dips into the low to mid 4,300 hertz. Silver tests the mid to high 70s or even the low 70s. And then you see buyers defend those zones. The curve doesn't collapse. Spreads don't fully relax. Physical demand remains sticky. That's the market saying, we're digesting, not breaking. And it's a healthy scenario, even if it feels painful in the moment, because it resets positioning and reloads the spring. Scenario 2 is the continuation squeeze. In this scenario, gold pushes back above $4,450 to $4,500 quickly. Silver reclaims $80, and the moves happen faster than most people expect because hedging flows kick in. Dealers chase neutrality. Shorts cover into thin liquidity. Stops trigger. The market gaps. This is the scenario where people who demanded a better entry end up buying higher because the market never gives them the tidy pullback they expected. The next detail is what flips everything. Both scenarios can happen with the same long-term thesis. The difference is timing and path. Your job is not to predict perfectly. Your job is to watch which scenario the market is choosing and manage your risk accordingly. Now let's build the viewer psychology shield, because this is the part that saves accounts. Volatility has a script it uses on you. First, it gives you a big rally and makes you feel smart. Then it gives you a sharp drop and makes you feel stupid. Then it gives you a bounce and makes you feel relieved. Then it gives you another drop and makes you feel betrayed. The goal is to get you to associate buying with emotional euphoria and selling with emotional panic. That's when you start making decisions based on pain relief rather than probability. The antidote is simple. Separate trend signal from noise. Trend signal is what happens around key levels and in the structure underneath. How the curve behaves, whether spreads stay tight, whether the market can reclaim important zones after a dip. Noise is the intraday violence that exists, because dealers are hedging and liquidity providers are widening. You don't cure noise by staring harder at the screen. You cure it by pre-committing to what you will do if certain levels break and what you will ignore if they done T. And here is the most important psychological trick. The market will often dip just far enough to convince you the move is over and then reverse. That's how it harvests late buyers and early sellers at the same time. You can't stop that from happening. But you can stop yourself from being the easy target by sizing appropriately and respecting that pullbacks are part of the process, especially after a historic year. This is also where skepticism becomes a superpower. The metals crowd loves certainty. Certainty sells, but certainty destroys risk management. The better posture is conditional confidence. If the curve stays tight and price holds this zone, the setup is intact. If spreads relax and price can't reclaim, I step back. That's how professionals think, and that's how you protect yourself from being emotionally manipulated by volatility. But that's not the part that matters most for the next 2 weeks. The part that matters is what to watch next, in order, because sequence matters more than prediction. First, watch gold's behavior around the $4,450 to $4,500 area. Does price reject it and slide with ease, or does it chew through it and hold? Chewing through is a sign of absorption, buyers willing to take what sellers offer. Second, watch silver's relationship with $80. Does it reclaim and hold, or does it get slapped down? Third, watch the curve and the feel of immediacy. You don't need to be an institutional trader to notice when the market starts paying more for now. It shows up as front-end firmness, as the sense that dips get bought quickly as the market refusing to stay down after bad headlines. Fourth, watch for the real-world physical tells. Retail premiums, availability chatter, large market price behavior. Not because you want anecdotes, but because physical markets can reveal whether demand is evaporating or simply pausing. Fifth, watch macro catalysts as volatility triggers, not as narrative drivers. Jobs data, inflation prints, policy commentary. These can spark moves, but the direction often depends on positioning and hedging structure, not on the data itself. A good number can still rally gold if it triggers risk-off positioning or currency stress. A bad number can still drop gold if it causes liquidation. The data is the match, positioning is the gasoline, and that's where the real pressure starts. Now, I want to be very clear about risk, because trust is built on honest framing. Price can whip around violently even if the thesis is correct. You can be right about the direction and wrong about the path, and the path is what destroys people who over-leverage or oversize. Metals can do the thing where they dip hard, trigger stops, shake confidence, and then rip. If you build your entire plan on not being shaken, you will be shaken. So the only credible approach is to assume volatility and design around it. That means thinking in horizons. If you're a short-term trader, your invalidation must be tight, your sizing must be small, and your respect for levels must be strict. If you're a longer-term investor, your focus should be on structure and regime, whether gold remains a system asset in a volatile macro, whether silver's industrial and monetary roles keep demand sticky, and whether the curve and spreads signal ongoing tightness. Two different games, same market. Don't mix them. because mixing them is how people talk themselves into holding a short-term mistake as a long-term conviction. Now, let's connect the institutional layer, because it matters for trust. When major banks publish ranges as wide as roughly $3,150 to $5,050 for gold in 2026, and openly discuss a $5,000 print as plausible, while also warning of a correction later in the year, they are acknowledging something important. Volatility is now part of the base case. That means the market is not pricing gold as a sleepy inflation hedge. It's pricing gold as a dynamic asset in a messy macro environment. Geopolitics, trade policy tension, debt, currency moves. And when gold's move is large enough to materially swing results for big reserve holders, it tells you that gold is not just a retail fascination. It's embedded in institutional balance sheets again. That doesn't guarantee upside tomorrow. But it explains why dips can be bought aggressively. Some buyers are not trading a chart, they're managing a system risk. And if the market has to ration metal into delivery windows, price doesn't negotiate, it jumps. That's the payoff. Not because someone decides it should, because the mechanics force it. Here's how that plays out in real behavior. If gold starts pushing through a key level like $4,500 and option-related hedging flows are positioned in a way that forces dealers to buy as price rises, you can get an acceleration that looks like a breakout out of nowhere. The news will chase it after the fact. The same with silver reclaiming $80. A reclaim can flip a huge number of short-term decisions from sell rips to cover now, and covering is buying. And buying into thin liquidity is how you get air pockets to the upside. On the other side, if the market fails at those levels and liquidity providers step back, you can get sharp downside moves that feel like the floor vanished. That's why your plan must include invalidation. If gold loses the low to mid $4,300 zone and cannot reclaim it, if the curve relaxes and spreads calm, that's your signal that the near-term pressure is releasing. If silver breaks through the mid to high 70s and then the low 70s without meaningful defense, and if the entire complex starts behaving like forced liquidation rather than controlled digestion, you respect that. You don't argue. You adapt. But if the levels hold and the structure stays tight, then the pullback is more likely to be noise, not trend reversal. And that's where the real pressure starts, because the market loves to convince you it's over right before it resumes. So what does starting this week actually mean in actionable terms without promising anything guaranteed? It means the market is in a window where it is most sensitive to flow. It means small catalysts can produce oversized moves because positioning and hedging mechanics are primed. It means you should expect volatility, not fear it. It means you should watch the levels that force behavior. Gold around $4,150 to $4,500 on the upside, and the low to mid 4,300s on the downside. Silver around $80 on the upside, and the $76 to $77 and $72 to $73 zones on the downside. It means you should monitor whether dips are bought quickly or whether selling persists with ease. It means you should pay attention to whether the market feels urgent, front-end firmness, quick rebounds, stubborn bids, or whether it feels relaxed, slow drifts, easy sell-through, narrowing volatility. That's the difference between a market winding up and a market unwinding. And the next detail is what flips the entire experience for you as a viewer. Once you understand that, you stop being shocked by volatility. You stop narrating every candle as destiny. You start treating the market like a set of constraints and incentives. That's how you build trust with yourself, which is the only trust that matters in trading. Now, I'm going to give you the near-term roadmap, 7 to 14 days, in a sequence that matches how pros think, because it keeps you from being whiplashed by every headline. Step 1, watch the reaction at $4,450 to $4,500 in gold and $80 in silver. Not the touch, reaction. Do we reject and fade, or do we accept and hold? Acceptance matters more than spike. Step 2, watch what happens on the next dip. Does the dip get bought faster than the prior dip? Does the market defend levels with urgency? That's the tell of tightening conditions. Step 3, watch for any sign of dislocation, anything that suggests the physical and paper sides are not perfectly aligned. It doesn't have to be dramatic. It can be subtle. But persistent subtlety is often the warning before the move. Step 4, watch positioning behavior around big calendar points. If the market begins moving sharply into late January options timing, you respect the possibility of reflexive acceleration. Step 5, decide your risk posture before the move happens. Because once the move happens, your brain will not be rational. It will chase, it will freeze, it will bargain. Your plan must be written in advance, even if it's simple. What confirms, what invalidates, what you ignore. That is how you avoid being emotionally manipulated. And that was the quiet warning I want to leave you with. Volatility will be used against you, not by a cartoon villain, but by the market itself. Fast moves trigger fear, sudden pullbacks trigger regret. Both make you act at the worst time. The defense is identity. You become the person who doesn't need to be first to be right. You become the person who waits for confirmation at levels that force behavior. You become the person who can say, if it holds, I stay with it. If it breaks, I step aside. That mindset is rare, and rarity is where the edge lives. So here's the subtle CTA that doesn't beg. If you're rebuilding that identity, finance literate, mechanism first, allergic to hype, then you're already in the right room. Stay close to the signals, not the noise. Watch the levels, watch the curve, watch the urgency. Because this is the kind of week where the market doesn't announce the move with a drum roll. It starts with the spreads tightening, the liquidity thinning, and one level flipping from ceiling to floor. And once that happens, the market can't unsee it.